For any serious investor, Warren Buffett's annual shareholder letters are basically required reading. But the one from 2018, it was a real head-scratcher, even for people who followed him for years. On paper, Berkshire's profits were swinging by literally tens of billions of dollars. So what was really going on? We're going to break it down using Buffett's own framework to find the real story hiding in all that noise. Okay, so here's the big puzzle. Think about Berkshire Hathaway. You think about these incredibly stable, rock-solid businesses, right? Railways, utilities, giant insurance companies. And yet, in 2018, their reported profits looked like they were on the wildest roller coaster you can imagine. How on earth is that even possible? Just take a look at these numbers. In the middle 2 quarters of the year, Berkshire reports over $30 billion in profit. Awesome, right? But then, in the other 2 quarters, they report a combined loss of over $26 billion. I mean, these aren't just little ups and downs. This is the kind of massive volatility you'd expect from some risky tech startup, not an industrial giant like Berkshire. What was driving all this chaos? Well, the answer isn't some dramatic story about a terrible business decision or disastrous investment. Nope. The real culprit was actually a pretty subtle but incredibly powerful change in the accounting rules. A change that Warren Buffett himself had warned everybody about. This new rule is called mark-to-market accounting, and basically what it does is force companies to report the day-to-day paper gains and losses from their stock portfolios as part of their official bottom-line earnings. So if the stock market has a fantastic quarter, Berkshire has to report a huge paper profit. But if the market tanks, they have to report a huge paper loss, even if they haven't sold a single share of stock. And here's the thing. Buffett totally saw this coming. A full year earlier, he predicted this exact rule would create what he called wild and capricious swings in their bottom line. His point was really simple. These paper gains and losses are just market noise. They have nothing to do with how Berkshire's actual real-world businesses are performing. And this chart is all the proof you need. The official GAAP number, the one that got twisted all around by those market swings, was only $4 billion for the entire year. But look at the operating earnings, the actual cash coming in from their businesses. A massive $24.8 billion. That number tells the real story, and it's a story of incredible stability and strength. So Buffett gives us the solution right there in the letter. He says, focus on the operating earnings. Just ignore the noise coming from the stock market's daily mood swings and concentrate on the real cash that the businesses are actually generating. And this idea brings us to the core lesson of the entire 2018 report. It's all about perspective. Instead of getting lost in the weeds of confusing accounting rules or wild quarterly reports, the individual trees, Buffett gives us a much better framework for seeing the big picture, for valuing the entire forest. He basically breaks the entire Berkshire forest down into 5 distinct groves. And he argues that if we can just understand these 5 core parts of the company, we can get a much clearer, much more accurate picture of Berkshire's true value than any single accounting number could ever show us. All right, so what are these 5 groves? What are the massive pillars that form the foundation of the whole Berkshire empire? Let's break them down. Here it is, the map of the forest. Grove 1 is all the non-insurance businesses that Berkshire controls completely. Grove 2 is its famous stock portfolio, Apple, Coke, and so on. Grove 3 covers businesses it co-owns with partners. Grove 4 is its incredible fortress of cash and bonds. And finally, Grove 5, really the engine of the whole thing, its world-class insurance operations. Now, Group 1 is the most valuable of them all. This is the collection of businesses Berkshire owns outright. We're talking about giants like the BNSF Railway or brands like Dairy Queen. In 2018, these businesses alone generated almost $17 billion in earnings. This is the solid, concrete foundation of Berkshire's value. Grove 2 is fascinating because it reveals a hidden value that those accounting rules completely miss. See, Berkshire gets dividends from its stocks, sure. But Buffett wants us to look at their retained earnings. That's the profit that companies like Apple keep for themselves and reinvest to grow the business. Officially, Berkshire can't report this as its own income. But in reality, it represents billions of dollars in real value being built for shareholders year after year. After Grove 3, which is about its partially owned businesses, we get to Grove 4, the cash hoard. At the end of 2018, Berkshire was sitting on a staggering $112 billion in cash and short-term bonds. Buffett calls this a financial fortress, and it gives the company unmatched security and, maybe more importantly, the firepower to go hunt for what he calls elephants, those massive, once-in-a-lifetime acquisition opportunities. And Buffett really drives this point about reality versus accounting fiction home with this classic line from Abraham Lincoln. He uses it to take a shot at CEOs who promote these fuzzy, adjusted earnings that conveniently ignore real, actual costs. For Buffett, it's simple. You can't just slap a new label on a cost and pretend it disappeared. Economic reality is the only thing that matters, not financial jargon. So when you step back from all this, what's the ultimate lesson? What are we supposed to take away from all this? It really all comes down to perspective, about shifting your focus away from the short-term noise of the market and onto the long-term reality of a business. This right here is a core Buffett belief. He's the first to admit that in the short run, stock prices can be totally wild and unpredictable. But over the long haul, a company's true business performance will always win out and be reflected in its stock price. At the end of the day, the business is what matters. And then, in a move that is just classic Buffett, he credits so much of Berkshire's success to something way bigger than himself or his partner Charlie Munger. He calls it the American tailwind. He's talking about the powerful, long-term growth of the U.S. economy that has created this incredible, prosperous environment for businesses like his to thrive in. And that really brings the whole lesson right back to us, doesn't it? Buffett's 2018 letter forces every single investor to ask themselves a really critical question. When you look at your own portfolio, are you focused on the daily price swings, those fleeting, distracting trees? Or are you focused on the long-term value of the businesses you actually own, the enduring forest? As this letter proves, that one distinction, well, it's everything.